A very good morning, good afternoon, good evening to all our viewers, distinguished panelists, our teams from SBI and group companies, our global custodian SGSs, our channel partners, and my own team from SBI-SG Global Security Services. Welcome you all to this annual event of SBI-SG, India Budget 2023, Opportunities in Capital Markets. We hope to do this as a signature event from SBI-SG going forward. Every year, the day after the budget is announced, the opportunities that the budget announcements will have in capital markets for the institutional investors from the perspective of fundamentals, impact on the fundamentals of companies, the tax reforms, the legal aspects, and the insights from the industry experts on how they can benefit from the budget announcements and a view we can provide to all the institutional investors. So this is going to be a signature event, and I welcome you all to this wonderful event that we are having today. The budget announcements have already happened yesterday. The markets have given their initial reactions. Today, again, we have seen the reactions from the markets. But then how should the participants in the markets read and understand more deeply, analyze the impact of the budget announcements and the macroeconomic impacts to take or reshape their strategies to operate in the India capital markets is something that we are waiting to hear from the panel of experts. We have the macroeconomic perspective, we have the tax perspective, we have the legal perspective, we have the funds perspective, and we also have the global custodians perspective coming up shortly. My colleague, Mr. Jignesh Mehta, will be introducing the panel to you all shortly. And as a market intermediary, we are very keen to understand how our clients would be impacted and what could be their strategies. And as you all know, SBI-SG Global Security Services is a custody services company. It's a joint venture from State Bank of India, which is the largest bank in India, and which is a financial services conglomerate with its presence in all the financial services, be it insurance, credit cards, mutual funds, and so on and so forth. And of course, the other partner is a global custodian, one of the top 10 global custodians of the world, Societe Generale, present in us through Societe Generale Security Services. And again, they are a huge player in the capital markets across the globe and a very well-renowned global custodian. We have been in commercial operations since 2010, and in these 13 years, we have grown from strength to strength, offering multiple services under the entire suite of custody services, clearing services, DDP services, professional clearing services, etc. to our clients, as also fund accounting services to our plethora of clients. We service foreign clients, the foreign portfolio investors, and those foreign investors who come through the FDI route and FECI route into India. We provide the registration for them. And also domestic clients like the asset managers, corporates, banks, trusts, and more importantly, AIFs. And of course, we are a part of the startup initiative of State Bank of India, where State Bank of India has these startup hub branches, which are connected to both AIFs and the portfolio companies, offering multiple services, transaction services, investment services, forex service, and of course, custody and fund accounting services through us, and trustee services as well. So this is the background about SBI-SG. I'm very happy to share with you that in this year, in the Agent Banks in Emerging Market Survey of Global Custodian, SBI-SG has substantially improved its scoring. We are one among the top 3 custodians from India. In fact, if you look at large custodians like us who are handling business upwards of $150 billion US dollar in assets under custody, possibly we have scored the highest among the custodians from India. So this is a good news to share with you, and hope to be present there at the Leaders in Custody Awards function of Global Custodian in May at Savoy Hotel in London, and maybe connecting with some of our foreign portfolio investors there itself in London. And currently we are managing assets under custody worth $190 billion and assets under administration through fund accounting services about $160 billion, and hoping to cross some benchmarks in the current year as well. We have channel partners and global custodians to whom we are connected, and all of us are very eagerly connected to this webinar, wanting to know from the panel of speakers what the budget announcements have in store for the capital markets. Thank you all for joining us with so much enthusiasm. And now let's tune into the panel of speakers. Jignesh, over to you. Thank you.
Thank you, Uma ma'am, for the introductory remarks. Good morning to the participants in US and Canada. Good afternoon to the Europe and the African colleagues. And good evening to Asia, Australia, and New Zealand. Thank you for taking time out from your busy schedule and joining us for this knowledge sharing event on the India Budget 2023. The budget is a critical event as it will drive the economy in the next year and help laying a firm foundation for the future. So folks, we had the India budget announcement yesterday by the Honorable Finance Minister, and we are pleased to bring an analysis from it. Let's begin the program with a macroeconomic overview on the budget from the Group Chief Economic Advisor of SBI, Dr. Soumyakanti Ghosh. Dr. Ghosh is a well-known figure in the Indian capital markets. He has worked at many prestigious companies like Tata AIA, American Express, ICRA, among the other entities as well. He serves as a member of the Indian Banks Association Monetary Policy Group and provides inputs to the RBI expert committee to revise and strengthen the monetary policy framework. He is also a member of the SEBI Advisory Committee on Research Economic Advisory Council. And he has authored several publications as well on the Indian economy. Over to you, Dr. Ghosh, for your comments.
Yeah, good evening, everyone. I will be a little short today, and in terms of the presentation timing, and I have actually some other work. So what I will try to do, I will try to be short and try to finish within the stipulated time. Just give me 2 minutes as I start speaking about this one. Just 1 second. Yes. Firstly, before I start with the budget, I think we have released a detailed copy on the budget. I have shared it on the that document is in public domain. So everything about the budget is explained in that document. So if you go to the if you go to the document, I mean, you're able to know the entire story about the economy, the budget, the fiscal consolidation, the markets, the sectors, everything, including the future, where we are heading. So all these things you'll get an idea. But keeping aside that, I'll just try to first give a perspective of how the economy is doing. See, in terms of the economic performance, I think some of the numbers actually speak out significantly. Let me talk a little bit about all those numbers before I go into the discussion of the budget, because that actually will conjure up the story of the budget. First, I think you all know that the global economy has been ravaged by uncertainty. Every year beginning 20 has started on a discordant note. 20 started on a discordant note about pandemic. 21 started with a second wave. 22 started with an Ukraine war. But the good thing is that 23 January has gone, and hopefully 23 is going to bring us more cheer. And there has been no unfortunate circumstances which has happened. So that's the first thing. The second thing is that the India has actually navigated the crisis wonderfully. Some of the numbers I will place before you. I think these numbers are extremely important for us to know. For example, regarding the external sector, if you look into the data, Indian rupee actually has appreciated in real terms by 1.4% since the war started. So that's actually some numbers. The foreign exchange reserves, which had declined by around 100 billion of the RBI has now recouped close to 60% of the foreign exchange reserves beginning October. In October, it was the lowest level. From October to the January, it has recovered 60%. Then the other remarkable data is that the exports of goods and services, we all talk about, and this is actually in our budget, we all talk about the fact that the global economy is facing a meltdown. So the exports of these countries actually could face a meltdown. But remarkably, Indian exports of goods and services has expanded by 16% in April to November of the current fiscal year over the corresponding period last year. And you note that last year we did 670 billion in exports of goods and services. Exports was 420 billion and services was 250 billion. So the remarkable thing is that all of us are talking about that export will be impacted, but in reality, exports on goods and services have actually expanded by 16%. And in all probability, if we go at the current rate, it is going to be closer to 800 billion goods and services exports this year. And I think in a year when the global economy is facing a meltdown, that will be a remarkable achievement. And the most important thing is that we did a recent exercise and the results are there in our report. So I will not talk a little bit about that. We have found that our exports are actually became agnostic to the global business cycle vagaries. This means that if we had taken a basket of around 17 to 18 commodities, so we found out that around 12 commodities are actually, even if the global business cycle is moving in a reverse direction, our exports are not getting impacted. So that is actually a good sign. We have gained market shares in high skill labor sectors. Several exports we have gained market share. Of course, there is some distance to travel in some of the sectors like textiles, which are labor intensive. But the good thing is that, and the PLI scheme is also mentioned in the report, because the PLI scheme is a significant fulcrum of moving the needle of Indian exports. And it has been doing that in terms of some of the export sectors like electronic exports. And the good thing is that the share of PLI in the overall budget is not even 1% of the GDP, and 0.5% of that actually has come through subsidy rationalization, mostly on petroleum in the last 3 years. So within 0.5% of India's GDP, the PLI scheme has been rolled over, I think, across 15 to 16 sectors. So this is basically the crux of the entire external sector story. The second story is basically on the UPI transactions. You will be surprised to know that the total UPI cumulative transaction in the current fiscal is now 99.8 trillion. So basically it is just shy of 100 trillion. And at this rate, and given India's GDP this year, which is around say 273 trillion, basically 3.4 trillion or 3.3 trillion, you can take the number as. If I express it as a percentage of GDP, it is 49% of India's GDP, and the total currency in circulation has increased as only by 1 trillion. So that means 100 to 1 is the ratio of UPI transaction to the currency in circulation. So you can understand what amount of revolution it has happened in the digital space. Next is the MSME sector. As you know that the bank credit this year has been continues to grow as a ferocious rate, and MSME sector is 10% of that bank credit. And we are now finding evidence that the MSME sector are getting bigger. This has been also repeated in economic survey, where there is a table in one of the reports which was recently published, I think, which shows that the per capita credit disbursement to MSME has actually increased. There are several reasons for that, but one of the reasons that the MSME is actually integrated with the global value chain. Notwithstanding that the Indian markets have been withstand to some disturbances in the last couple of days. But if you look into the holistic picture from March 2020 till today, the market capitalization of NSE have actually increased in dollar terms by 2.3 times and in overall terms by 2.5 times. So that's again a remarkable achievement. So we haven't, and the other important thing that the tax to GDP ratio has in the yesterday is actually at 11.1%, which is the highest since FY19. So if I look into all numbers, fiscal deficit, if you look into all the numbers in terms of the fiscal one, in terms of revenue expenditure, in terms of tax buoyancy, in everything we are doing very well. And my sense is that this actually forms the fulcrum of the budget presentation, which happened yesterday. Now, let me come to the budget part one. The first thing about the budget is that actually the budget, and this has been the hallmark of the current government, that this government has not ever gone through the path of fiscal consolidation or fiscal prudence, even in a year which when the global economy was ravaged through pandemic, and India is perhaps the only country where the tax to GDP ratio had increased during the pandemic. So I think that's one of the remarkable things. Other countries were giving out those who are actually trying to see whether we can do a targeted fiscal intervention. We also did a targeted monetary intervention in terms of liquidity distribution to the stressed sectors, and in terms of announcing a moratorium for the stressed sectors. So I think there was enough monetary and fiscal conditions. The first thing which we have done is that we have put the fiscal deficit at 5.9% of our GDP. I think we are also expecting a similar number. The nominal GDP growth rate has been put at 10.5%, which is a very reasonable number. The tax growth is also at the same level. In fact, an interesting data point which I want to present before you, that if you look into the last 50 years tax buoyancy, beginning from 1970 to 80, 80 to 90, 90 to 2000, 2000 to 2010, 2010 to 20, and 2020 to 23. And this is actually there in our report, shows that the tax buoyancy generally in India is around 1.1, but in 2020 to 23, the tax buoyancy is actually increased to 1.5. There was a significant jump, corporate tax buoyancy, income tax buoyancy, and remarkably, this year's budget assumes a buoyancy which is in fact lower than 1. So my sense is that the numbers which the budget actually has targeted are going to be met, very prudent numbers, pragmatic numbers, and my sense is at the end of the day, we can actually see a situation which the government has been doing for the last 2 years, that in promising less and delivering more. Now, this is the first thing. So now in nominal GDP, you can always ask the question that what is the real GDP growth rate and what is the inflation rate? Real GDP, I'll tell you, I think there has been several projections in public domain. Some report talks about on growth rate, which could be some international agencies start talking about a growth rate of, I think, around close to 5% or 5.5%. But we are not in the camp. We are projecting a growth rate in excess of 6%. Currently, we are at 6.2% there, but there are possibility of it getting revised as the year progresses. I will tell you why we are confident on the real GDP growth rate. Inflation in India, as you know, has been across economies has been a problem, but inflation has been significantly surprised in the last 2 months. And take it from me, the inflation trajectory for India now looks very reasonable. I mean, the way the food prices have behaved, we could actually move towards 5%, closer to the 5% inflation target by March. Maybe we'll be able to bring it down below 4 to 4.5% by April. And if this is the inflation trajectory, and also given the fact that global economy is going for a soft landing, there will be correction in the commodity prices, there is already correction in the crude prices. So that is, and given the fact that we are working with a very high base, the WPI basket could actually turn negative in the first quarter of the next fiscal year, basically between April to June. And if that is the case, you know that for the Indian GDP, this is basically just a small example I wanted to give you in simple language, is that when you use the GDP deflator, whereby you use the nominal GDP and deflate and arrive at the real GDP, that is more biased towards WPI. And WPI actually doesn't contain more of the services items. So the fact is that if the WPI significantly declines in the month of April to June, we could actually see the real GDP growth rate surprising on the upside. So watch out for the data when it is released in August. My sense is that the GDP growth rate next year will surprise, because all these factors, external factors in terms of a low, low oil prices, low metal prices, could actually be growth supportive, and we could look into some growth rates which could be much higher than what the market was expecting. Now, so this is basically the first thing. The second thing is in the budget is the borrowing numbers. The borrowing numbers again has been very prudent. The market was expecting a borrowing numbers of anything closer to 16 trillion. But it has come in a number which is now closer to 15.5 trillion. The net borrowing numbers is actually lower than 12 trillion. And market was expecting higher than that. And my sense is that that has been also gladly accepted by the debt markets. The debt markets, if you look into the 10-year yield since yesterday, it has been rallying. And the remarkable thing is that, see how, and this is another part of India's resilience, that we had last year, the total borrowing was around 22 trillion. And this year also around 23 trillion in terms of center and states. Even after that borrowing, and even after epitaphs of stories were written in media that the yield could actually cross 8%, I think there were stories all around that yields actually has remained significantly anchored below 7.5%. And why it has remained at 7.5%? What I will say, the accolade should actually go to the RBI and government of India also, in the sense that there has been also a fundamental shift in the borrowing patterns in the market, because insurance companies are now more into the market in terms of the longer dated papers. Banks, insurance companies, as you know, are the largest participants in the debt market. So that actually has helped in terms of an yield control. And as Governor Shaktikant Das of RBI has famously made the statement that yield is a public good. Actually, yield is a public good. Yield has remained in constant. The Reserve Bank of India has been front-loading the rate hikes. Everybody talks about the rate hikes from 4% repo rate to 6.25, but we all forget that the hike actually started from 3.35%, which was the lower bound of the repo rate. Which was first hiked by 40 basis points, and then the repo rate was started to got hiked. So RBI has been front-loading the rate hikes, and even after that, the credit growth and deposit growth today, that is another resilience of the system. The credit growth today is at a 10-year high. The asset quality, the NPA levels of the banking is actually at 10-year low, and the credit and deposit growth from pandemic is 1.3 times higher. So the banking sector, so that is another part of the story. Even after rate hikes, the Indian economy has continued to remain buoyant. Yesterday, there was a story in the paper that the Mumbai sales, the housing sales in Mumbai in the month of January were at record highs. And when you compare the Indian property market with the Chinese property market, you will actually find that Indian markets have been booming in the last 6 to 7 months for whatever reasons. And that gives us confidence that rate hikes with the RBI, which possibly is now towards the end of the cycle. There are divided cycles of whether there will be further rate hikes in February or not, but that's a separate question. But the story is that we are actually on a switch path in terms of the growth. Now, having said about the deficit numbers and other things, tax revenue numbers, so basically in terms of the fiscal deficit numbers, in terms of the borrowing numbers, even in terms of the tax revenue numbers, let me give you another the point over here. I think that the government actually has been pushing people towards a new tax regime. I think there is a lot of debate in India whether the old tax regime is beneficial or the new tax benefit is beneficial. But without getting into that debate of which one we should sit, even though my simple point is that in theory of public finance, I think basically an incentive, of course, sometimes you need incentives in a country like India, but the point is that there should be a clear distinction between short-term savings and long-term savings, and the new tax regime actually makes that distinction, because what is happening is that in the short term, you may not be getting the benefits if you are investing for certain section, but in the long term, you have the benefit because in the long term, your total corpus is not going to be taxed. So I think there are benefits of a new tax regime, although there has there is a debate on how many people will shift. But the good thing is that GST collections has continued to be buoyant. January GST collections were the second highest since the entire year. It was at 1.56 trillion. And even after, if you adjust it for the inflation deficit, the gap between the real and the nominal, the gap between that is actually very low. And this has happened. This shows that the economy is on a formalization drive. And my sense is that the trend or the reservation level of the GST revenues in India is around, could be heading towards 1.5 trillion. If that is the case, in the future, I think it could be possibly easier for the government to move further towards a low tax regime for the personal taxes. But that's a matter of debate. But I am sure that the way the government is trying to move towards a regime which is clutter-free without incentives, and that actually shows that the benefits of the indirect tax regime could actually cross-subsidize for a better personal indirect taxes, the personal taxes regime in the future. Now, there are other several points in the budget. I will mention some of them. The SME sector, let me give an example. The SME sector, the government has been trying to do a lot of initiatives, and the budget also talks about a lot of initiatives. The budget, and this is basically a suggestion which has been given by the State Bank itself. The budget is actually going to work on a new credit guarantee scheme, and that the budget says could actually reinvigorate credit growth to the SME sector by 2 trillion. The other important thing is basically the budget also is introducing incentives for the MSME sector, whereby you will integrate this, that is called the Prime Minister Vikas scheme, whereby it will integrate the artisans with the MSME value chain. There are also other examples of the MSME sector, but the most important thing is that the MSME sector, the government has taken a lot of initiative, and there is a portal which is called an Uddam portal, which is actually registering all the MSME small enterprises on a rapid scale. And my sense is that if that is done, there could be significant formalization of the credit growth in the economy. So that is regarding the statistically MSME sector is one of them. In the agricultural sector, the government has actually said that it is going to use data, and that is going to be used, it will be basically digital agriculture, and that will be used as a public good. So I think that's a very good initiative, because in the agricultural sector, there has been significant digitalization. As you know that KCC, the Kishan credit cards, today the total number of Kishan credit cards in the system is around 7.14 crore, that is 71 million. And what is happening is that because of this, the agricultural credit and the KCC grant, the agricultural credit is getting formalized, because as you know that India also had a system of money lenders. So the farmers have slowly moved away from them, and this digital infrastructure of public good actually will ensure that the agriculture can move up the value chain, and we can look into the farm to fork sector in a better manner. And I think that is one of the initiatives in the government. Another important data point I will like to point out is that the government, as you know, has introduced the ENAM market, which is basically the digital market, and the prices in the ENAM market in some of the commodities are now actually higher than the minimum support prices, indicating that there is evidence of price discovery which is happening. So agriculture is another initiative which the government has given a lot of things. For the women also, the government continues to provide the financial empowerment of the women. There are several data points in the public domain. For example, incremental bank deposit last year in rural areas show that every 1 rupee 66 paisa was actually mobilized by the women depositors. And the government is also actually running some schemes whereby it is mapping the 6 lakh villages by giving them property rights. And we are seeing that in some of the villages or some of the states, some of the districts, the women borrowers are actually taking lead over the main borrowers in terms of housing loan disbursements. So these are some of the remarkable things which are happening in the Indian economy in terms of empowerment of women, and the budget actually speaks a lot about that. The other important thing is that the budget also gives some clear focus of the green transition and climate adaptation. The Indian Railways is now going to get 2.4 trillion. As you know, the capital expenditure this year in the budget is around 10 trillion, which is in 33% growth. And the overall capital expenditure of the central public sector undertakings and the creation of assets is actually 18 trillion, which is 14% growth over last year. And in fact, from pandemic to post-pandemic, there is a reorientation of government finances in India with less subsidies, more capital expenditure, and more revenue growth. I think that's the way to go. And I think possibly that is the coordination which India has witnessed during the pandemic in terms of fiscal and monetary. The other important thing is that there has been several initiatives which the budget has announced. I'm not getting into that because energy transition, it has announced on 35,000 crore initiatives. Battery energy storage systems will also be put up. The financial sector, the one important point is the financial sector has talked about a financial registry, a registry of databases of the borrowers. I think that could actually be a game changer in terms of better credit discovery. The agricultural sector also talks about this digital capital registry, and my sense is that once these systems are rolled out, the benefits will be available to the good borrowers in the banking system, and also the borrowers at the bottom end of the pyramid, who can be able to get a loan from the banks at lower rate of interest. So regarding agriculture, the KCC, the financial registry, the KYC also will be updated and unified in one place. So these are all positive for the banks. The other important thing is that education, health, backward, tribal population and sanitation have also got a lease in the life. So the other thing, education, for example, there is a lot of institutes will be set up for the tribal people in the bank. And my sense is that I will end the discussion by saying that the year, we are in a year, I mean, we are actually marching towards an year of Amrit Kal. And the initiatives which the budget has shown in terms of remarkable resilience, in terms of the numbers in every sphere, in terms of the government finance, in terms of the external sector, in terms of a strong banking sector, in terms of an market capitalization, in terms of any data which you ask me, I think India is marching ahead. And the budget document I have, we have published the budget document, and that I have put it in the public domain. So anyone can go through it. That gives you a comprehensive coverage. And the important point to note is that another data, for example, just came to me is that the 100 critical transport infrastructure projects for ports, coal, steel, fertilizers, and food grain sectors will be identified, and they will be taken up with a pilot with an investment of 75,000 crore. So I think there are enough numbers in the budget which gives us a hope. Yes, and I will end this discussion by saying that yesterday the Fed actually has hiked the rate by 25 basis points. So it looks that we are now moving towards an end of a rate hike cycle in Fed. Even though I think if I look into, I'll give an example over here. If you just hold with me, just give me a minute. I'll just speak about something which is very interesting. Just give me 1 minute. Just 1 second. Just 1 second, and then I'll end. Yes, what I'm trying to say is that, I mean, I'll end this. I think I'm not getting is right now. Basically, if you look into the tone of the Fed over the last 7-8 meetings, the first time the Fed was talking about, and that talks about the uncertainty. The Fed said the inflation is transitory. Then it said it is temporary. Then it said it is longer than temporary. Then it is said it's narrow based. Then it is said it is broad based. Then it is again said it is narrow based. So basically, if you look into the language of the Fed over the several last 2 years, the language shows that how uncertain is the global world. So the base thing is that nothing in a world where the only certainty is uncertainty. I think India has done very well, and the markets yesterday had greeted the budget with strong amount of enthusiasm. And my sense is that if you are able to carry out with this capital expenditure extravaganza which has been put out in the budget across all infrastructure sectors, I think the growth rate this year could be in for a positive surprise. I will end here and thank you for the opportunity.
Thank you, Dr. Ghosh. It was a wonderful session from you and your thoughts. Just one point that I think comes out from your discussion. Considering all that you said, does the budget have enough, for the 5 trillion economy that India is targeting, with a growth of around 7% or so in the coming years? When you made your last point. Dr. Ghosh, you're on mute, I think.
The first trillion of the Indian economy was achieved in 57 years. The second trillion was achieved in 7 years. Then what is currently happening is that now we are adding 1 trillion every 3 years. But the important point to note is that the last 2 years, we have added close to 780 billion. And that number actually was more than 900 billion, but the number came down because of the external disturbances. And 2 billion, so we actually added 777 billion to be more precise in the last 2 years. So we made an estimation. We said that if the aspiration is to add every 1 trillion every 2 years, then India can actually be the size of a 20 trillion economy by 2047, and that will all. And the important point to note here is that that assumes an extended depreciation of around 1.5 to 2%. The point to note is that I think if the government is also making an honest effort in terms of the rupee internationalization, my sense is that if those measures come through, then we could actually be close to that number, maybe before 47. It's a difficult task, but I don't see any reason why you can't do it, because it's basically a simple calculation of whereby you add 1 trillion every 2 years and the exchange rate stays stable, and then you're able to touch the 20 trillion, because nobody thought that we'll be able to add close to 777 billion in the last 2 years. Of course, there were factors in terms of the inflation and other things, but that actually, even if we keep that factor into account, I think the economy has remarked back very well. Okay.
Thank you once again, Dr. Ghosh. Thank you so much for your time.
Thank you. I'll take a leave. Actually, I have to just catch up with something. So if you kindly allow me, I'll take a leave.
Sure, Dr. Ghosh. Thank you so much.
Thank you.
Our next panelist is Mr. Srinivas Jain, who heads strategy at SBI MF, and he has been associated with them since 2001. Apart from being the Chief Strategy Officer, Mr. Jain also oversees digital technology teams to manage key strategic initiatives. He is also responsible for international business development initiatives and represents the organization on various sustainability initiatives. Over to you, Mr. Jain.
Yeah, thank you. Thank you very much, Ignesh. Thank you for inviting me and giving an opportunity to talk about SBI mutual funds and our view about the markets. It's a very tough task to go after Mr. Ghosh. I think he is one of those guys who's thorough, and I think he's covered kind of everything that I wanted to talk about. So let me see how can I make this a little more interesting. I actually had a fairly lengthy presentation, but in the interest of time, if you give me a second, I don't know if you can see my presentation here. Yeah. Am I visible? All right. Okay, perfect. So what I will do is probably not take too long, even though the presentation is too long, take you through this really fast. Here are our first cut views about the budget. And like Dr. Ghosh said, we are very happy to see the vision towards fiscal consolidation. 4.5% fiscal deficit target is a very positive step, and I think it's well appreciated. Especially something very interesting is the subsidy outgo. And this whole movement from revenue expenditure to capital expenditure is a fantastic initiative, and it's happening. Actually, the growth is happening. I have a slide there to talk about after quite a long time. Capex outlay is a big thing, and it's going to build a big post. One of the key engines, I think Dr. Ghosh kind of talked about it, is the whole green transition. I think we've picked up this theme extremely well, and I think there's so much more that India can do in this whole green transition, and the amount of money and the initiatives that the government has put in here is significant. While the rural budget has been contained, the productive scheme on the rural budget, like drinking water, housing, irrigation, all of them have been increased, which are all very critical. We've seen that the tweaking of tax slab is now going to spur the entire disposable income, and more importantly, the consumption, because you'll have more money in the system in the hands of the savers. While I think the fiscal arithmetic looks broadly achievable, I think there seems to be some optimism in revenue buoyancy, because I think at a 15% growth in tax collection, revenue collection seems to be a little more optimistic. But I think, like Dr. Ghosh talked about, knowing the buoyancy in what we saw in GST collection in Jan itself, I think this is something also that government, I think, will be able to achieve. From a fixed income market standpoint of view, I think the net borrowing at 15.4 trillion and 11.8 trillion on our net borrowing is definitely better than market expectation, and you see the markets have given a thumbs up to that. One of the things that there was some arbitrage that was happening, especially in terms of high net worth investors' money moving into MLDs and high insurance policy schemes, that has kind of gone away with the budget, and I see that as a good positive for fixed income assets, especially debt mutual funds. On equity, of course, all the tax changes that have been done, infra push, autos, and I have a couple of slides to talk a little bit about individual subsegments, how they're benefiting. And one of the, as we got into the budget, there was this big fear in the industry about what is going to happen to the capital gains, what is going to happen to the STT. I think the fear has been now laid to rest. There's nothing that has happened there that's been completely untouched, and the markets have given a thumbs up to that. Prima facie, we believe that budget 2023 should give both equity market and fixed income market a picture. We see that happening, except for one or two stressed events that happened in equity market yesterday. Overall markets have been positive, and today again markets have ended up flat, which is a good news. In the interest of time, what I will do is very quickly take through this presentation. This is the number of the budget. We talked about fiscal consolidation. Look at how things have moved over here. It's a very impressive style. And again, what I will do is move a little fast because I have quite a lot of data points to talk about. And some of them were already talked by Dr. Ghosh, so I'm not going to repeat them. This is the revenue targets. This investment is something that we didn't hear much about, I think, but there seems to be more optimism on that from whatever we've heard. This is an interesting slide where we talk about how after a while you see the investment in capex is now rising significantly when it comes to compared to the RevEx. Right? So yeah. So I'll probably go a little faster, and we can have questions if anybody is interested in a little more of detail, especially considering the interest of time. Infrastructure spending, I think Dr. Ghosh talked again about it. This is one of the biggest spends that we see. This is an interesting side. We are talking about the PLI scheme now, almost at $81 billion worth of subsidy, 81 billion rupees worth of subsidy. It's a huge huge investment government is backing with PLI and all this 13 sector. And of course, they're expecting more sectors to come into the PLI scheme. Fiscal deficit was talked about. What I'm trying to do is rush through. Small savings has taken a big boost. I think this time we expect small savings to contribute, more than before to the overall kitty of the government. I would like to take this slide and next few slides a little more in detail. See, what we've done is, we've tried to break up the budget from a sectoral point of view, so that we understand which are the sectors which are kind of benefiting from this perspective. You have agrochem, which is positive, airlines are positive, auto and auto lines. I'm not going to read about what was the budget announcement, but generally talk about it. Chemicals, while overall was negligible, there was not a big move there. Construction, very positive with the focus on infrastructure. Consumer durable, extremely positive with both PLI schemes being announced. Financials, we are positive overall, except for certain MLD structures which will have some negative impact. Healthcare overall very positive. This has been a good budget for healthcare. Industrial, again, positives for capital goods. Oil and gas, positive. Pipes, positive. Power, very positive. REITs, of course, because of this whole new taxation on REITs, it seems to be negative for the real estate. And of course, the long-term capital gains, reduction from, for above 10 crore is also a negative for kind of real estate. There was not much news for the textile, which is kind of negative. And the big theme, of course, was the whole decarbonization theme. And I talked about it. This has been the best green budget you can talk about. You had the green mission, hydrogen mission announced before this. You had specific first-time allocation to net zero objective of 35,000 crores in this budget. Special call out on the battery energy storage system viability, cap funding of 4,000 megawatt battery storage. There's something called Green Credit Program, which we would like to see what it is. It seems to be an interesting initiative to fund green finance. And there is a 500 Waste to Wealth initiative, the Govardhan scheme, that the government has announced, which is an interesting initiative, and there is an outlay of about 10,000 crores on that. Consumer, of course, while the NCCD of cigarette increased by 16%, overall compared to what industry is expecting, it was definitely lower. So there has been some positive news there for the cigarette industry and the overall consumer industry. Cement has been positive because of the construction and of course PMAY scheme allocation being improved, and oil and gas have also benefited from this budget. Now, when you really look at it, and I'll probably go through this very quickly from a equity market perspective, and I'll probably quickly jump into, there are a couple of things happening. The equity market continues to be expensive. When you look at this chart, it tells you that we are still more expensive than other EMs globally. Sentiments, which used to be positive, has kind of turned neutral in the last month. So overall, when you look at equity market, we believe that there is a global sluggishness which will have some rub-off in the Indian growth. We believe that growth is likely to moderate for to around 5% for the initial quarters and later on pick up in the coming quarter. Valuations, even though they are stretched, but then somewhere down the line, I think the earnings will kind of catch up in coming days. We believe that in 2023, it's going to be a year of volatility for equity market. So there is an ability for investors to look beyond equity market and look at bonds and golds as a diversification option. But of course, staying invested in equity market will play out because this is a cycle that equity markets always goes through. Let me just quickly take you through fixed income. Again, I have a lot of slides. In the interest of time, I'm just going fast. Of course, this is something yield curves have become flatter and flatter as you see here. So there's a lot of slide on liquidity and borrowings, which again, this document is also in public domain. It's available for anybody to have a look. It's available on our website also. Quickly, we do a debt market outlook, and then maybe we can take question after that. Most taxation and others. So globally, I think like Dr. Ghosh said, there is now maturing of the rate cycle. India itself, we've seen about 300 basis point in this fiscal worth of rates, and I think over one more hike, we may start moderating. And some people believe the hike also may not happen. Overall, I think the RBI's commentaries have suggested that there's an acceptance for with a low real positive yield, and I think RBI may fight aggressively to move towards a 4% inflation target that they have in mind. Balance of payment and rupee is still one big hanging sword. We need to see how the macro picture will play out. Overall, I think by the second and third quarter, we'll have a better picture there. Liquidity has tightened considerably and stays under pressure going ahead, given our worry on the external account deficit that we talked about, but short-term rates could raise in coming days. Finally, we believe the corporate bond spreads, though are tight, are getting a little better in select segments, which gives more opportunity for debt funds market to be more buoyant. And I think this is a year of fixed income and debt funds market. Probably what I'll do is stop here. I have a couple of other slides, but stop here and maybe take any questions if there are more questions on this. Thank you very much.
Thank you, Mr. Jain. It was a wonderful session that you took. What we'll do is we'll take the questions at the end. So since we have few other speakers as well. So
Okay.
Thank you. We now move on to Mr. Vishal Khanna. Vishal is a partner at Pricewaterhouse in Mumbai and has over 20 years of experience in the Indian tax and regulatory matters. He works closely with business and tax teams across jurisdictions and in evaluating business and products, initiatives, services, migrations, and providing key, interesting facts to the clients on these things. Over to you, Vishal.
Thank you. Thanks, Jignesh, for that very kind introduction. Greetings to the audience and my fellow panelists. I'll just put up my a very short slide deck I prepared to go through the tax changes. I hope you can all see it now. Right. Is the deck visible now? Okay, thank you. Right. So getting started and very quickly on some of the very key tax changes that impact foreign portfolio investors and other foreign investors. Let me start by mentioning a change that was not announced yesterday, but will be effective a couple of months down the line. And this is the tax rate for government bonds and corporate bonds and loans given by foreign banks, investors to Indian corporates. So that entire segment of non-resident subscribing to a bond or debt in India, including government bonds. Presently, the tax rate on all of that under the Indian law is 5%. You load on a surcharge and cess to that, and you get an effective rate around 5 to 7%, depending on the status of the non-resident taxpayer. This clause or this provision, which allows a 5% rate of tax on corporate and government bonds, has a sunset of 30th of June 23, which means that from 1st of July 23, the effective rate of tax on such instruments under local law will revert to 20%. The 5% rate was introduced about 10 or 12 years ago. It was renewed 2 or 3 times, and there was expectation, even anticipation, that this will get renewed again, but that has not happened. So the effective rate of tax on these bonds, like I said, will be 20%. And you again load on a surcharge and cess to that, it will go up to 22 to somewhere around 28%, depending on, again, the status of the taxpayer. Now, all is not lost, because if you come from a treaty jurisdiction or a jurisdiction which has a tax treaty with India, there could be eligibility to claim a lower tax rate than what is mentioned under the Indian law. So Singapore is a typical example that comes to mind. For FPIs that invest from Singapore, the rate under the tax treaty for interest income is 15%. And there would be eligibility to claim that rate. An even better proposition is to claim a 10% rate in the IFSC. So as you're probably aware, India has this IFSC regime now, very favorable tax rates available for foreign investors who come and invest into the Indian capital markets through the IFSC framework. So that is where you get a 10% rate. I just wanted to lay that down because, with the heavy capex push, etc., India will have a lot of requirement for borrowings. And I think fellow panelists have earlier spoken about the amounts of government borrowing, corporate borrowing, etc. But the rate of tax on coupons seems to be going up as it's mentioned on this chart. I'll move on to the next one, and these are the key direct tax proposals that were indeed announced yesterday and are effective and applicable to foreign investors. The first one is distribution of principal repayment. So any upside income earned by a investor in a REIT or InvIT beyond the normal interest, dividend, and rental income would now be taxable in India as income from other sources, which means potentially it could be a tax rate higher than if such income was subject to tax as capital gains. So that's a negative, and I think Mr. Jain was mentioning that in his presentation as well. The next one, which is important, is the benefit of tax treaty rate for purpose of withholding on mutual fund units has been extended to non-residents. So up until now, non-residents were not eligible to apply a lower withholding on income from mutual funds. That provision has been brought in yesterday. Another key change is the taxation of market-linked debentures. So any debt instrument that does not have a fixed rate of interest, but is instead linked to a market index, a share price, MIBOR or a floating rate type of instrument, could potentially be subject to tax as short-term capital gains instead of the normal long-term capital gains if I would have held that instrument for 3 years plus. So that's a significant change which impacts investors in market-linked debentures, because if you were holding that instrument for 3 years plus, you would normally pay 10%, which is the long-term rate of tax. But now there's a deeming provision that says that any redemption or maturity or transfer of such instrument, gains from such a transaction would be seen as short-term and be taxed at a higher rate. Clearly, a relaxation regarding NBFCs in India, non-banking financial companies, are now proposed to be kept out of the thin capitalization rules. This was earlier applicable to banks and insurance companies, and now it's been a long-standing demand of the industry to keep the NBFCs out of that provision on thin capitalization, and that has been proposed in the budget. The other point I wanted to cover is a slightly procedural one, but important, because India at some level is known for having a lot of tax litigation pending, even at the tax authority level. And the government is making focused efforts to see to it that these disputes and litigation are resolved quickly. And to that end have undertaken to appoint a number of joint commissioner appeals for tackling these disputes in an expedited manner. So that's a key change for dispute resolution. I'll quickly now switch to tax incentives in IFSC. And two key changes which are interesting from a tax lens. The first one being that a relocation of funds to IFSC. So India has this provision with again a sunset of 31st March 23, where a foreign fund could seek to relocate to the IFSC, and that relocation is a tax neutral relocation. So there is no India tax implication if you relocate an offshore fund into the IFSC. The sunset for such relocation to be tax neutral was 31st March 23. It's now been extended by 2 years to 31st March 25. The next one is again a significant change for offshore banking units or IFSC banking units, units or branches of foreign banks operating in the IFSC. They are now allowed to issue overseas offshore derivative instruments, and that's a typical instrument for market access for foreign investors. So there is a regulatory angle to that entire change, and I'll let Prakhar cover that subsequently in the regulatory section. But the tax impact of this change is that any transfer of an offshore derivative instrument from one investor to another, or an unwinding of such instrument or a redemption of such instrument, was tax-free up until now. That tax exemption has been extended to any incomes that are distributed by a IBU of a foreign bank operating in the IFSC upwards to investors. So if an investor has signed up to an ODI and the IBU has bought shares or say dividends in or a debenture in an underlying investee company in India, when the amounts of dividend or interest are repatriated, are received by the IBU from the investee company and further repatriated to the UK investor, that repatriation is tax-free or is sought to be made tax-free going forward from 1st April 23. So that kind of increases the likability, if I may, of setting up fund businesses or foreign banks opening up their ODI-related market access type businesses in the IFSC, given the low cost of operating and employee cost, etc., and this added tax advantage and the tax exemption, has made this move very, very exciting and something that banks should possibly look at if they want to offer market access products from the IFSC. So those are the key changes from a FPI perspective. I'll just pause here, and Jignesh, it's back to you.
Thank you, Vishal. It was a good, insight into the taxation aspects of the budget. I think the moves that have been announced are going to really help GIFT City, right?
Indeed, and I think if you look at the budget over the last 5 odd years, every year there's been some tax and regulatory change, and most of it comes out of demands from the industry on things that they want to change to be able to do more business out of the IFSC, and the government has moved to do that. So yeah, the direction remains the same, to give more certainty, clarity in the IFSC. Yes.
Yeah, that's it. Thanks, Vishal. We move now to our next speaker, Mr. Prakhar Dua. Prakhar is a leader at the financial services and regulatory practice in Nishit Desai and Associates. He specializes in securities and foreign exchange laws, including structuring of inbound and outbound investments. He frequently interacts with SEBI and holds expertise in advising offshore hedge funds looking to make investments in India. Over to you, Prakhar.
Thank you, Jignesh. Thank you for inviting me. So I'll focus on the regulatory aspects of financial services and regulatory reforms. If you have heard the budget speech of Honorable FM, and or you've read the fine print of the finance bill or the budget speech, then what comes across is that the focus has been on macro level issues to promote overall economic growth. And from a regulatory perspective, we can't say many changes being made on foreign direct investment side or FPI side or overseas investment regime. But there are a few aspects which we can highlight. I'll just share my presentation. There are a couple of slides. Just one second. Yeah, so let's go to the issues. I have divided my deck into 2 slides. One will focus on the changes which have been introduced on the financial sector front, and the second will be on the GIFT City front. First key change what Honorable FM has proposed is that there will be public consultation for releasing any directions or regulations by the financial sector regulators. Now this approach we have seen a lot happening when SEBI comes out with certain rules and regulations. They in most of the cases they come out with consult papers. The public can give their comments and SEBI takes those comments into consideration. We haven't seen such consultation papers being released by Reserve Bank of India often. Maybe after this proposal, we'll see a lot of consultation papers, not only from SEBI, but from IRDAI, PFRDA and RBI as well. Second, the second proposal is that there should be simplification and cost reduction in compliances, and also specific timelines should be prescribed for filing of the applications. Now, this should be a key change, and this is very relevant as well, because just to give you an example, now let's say we file an approval. So if there's any government approval which is required for making an FDI in an Indian entity, we are supposed to file an application with the government with the DPIIT or DEA, and then the government looks into the applications, and then on the merits they decide whether to allow that FDI to be made into an Indian entity or not. Now we have seen a lot of time being taken by authorities in approving those applications. Also, recently, what change has been made is that earlier we used to file these FDI applications on foreign investment facilitation portal, which now has been changed to NSWS portal, and we have been facing few lags on that portal. And even after you file the application, the regulatory bodies, the ministries, and the government take a lot of time in coming back, and even if they are not even if they are not permitting the application or the approval, then also it takes around sometimes it takes 5 or 6 months or 7 months to get that rejection also from the government or from the ministry. The other example can be that the applications which are filed with the government for seeking PN3 approval. Now, I understand this is more from a government perspective and not from any financial regulatory body. But press note 3 applications where there is some a tinge of investment from any of the neighboring countries, those applications also take a lot of time, and sometimes it takes a year or two, and there has been no fixed or prescribed timeline for getting those approvals. So maybe if that is improved or that is relaxed, or a timeline is fixed by the government, that will help a lot in seeking more of foreign direct investment in the Indian entities. The third reform which has been proposed is that there will be amendments in the Banking Regulation Act, the Banking Companies Act, and the Reserve Bank of India Act. Now, Finance Bill does not contain those changes or those amendments as of now, but we are hoping that those amendments will be made in due course and to facilitate governance in banks and to also facilitate investor protection measures. This is also very important in light of the macro level issues which are prevailing right now in India. The fourth key consideration, which the key reform which we can look at from the financial sector perspective, is the capacity building in securities market. Now, you may be aware that there is a National Institute of Securities Market, NISM. It's basically a public trust which was set up in 2006 by Securities and Exchange Board of India, by SEBI, to basically promote financial literacy and financial education in India. Honorable FM has proposed that SEBI will have the authority and the power now to decide the curriculum of those courses, to promote these courses, to monitor and govern the syllabus which is being taught in these institutions, and also to accept the certificates or the degrees or the diplomas which these institutions grant to people. This is a very welcome step, because lately we have seen, and especially over the we have seen a lot of financial literacy happening in the market, a lot of IPOs happening in the market, and a lot of retail participation in the stock market. I think this is a very, very welcome step, where the focus will also be given on spreading financial literacy and education, so that retail investors are also at par with the institutional investors when it comes to investing in the listed market of India. Now, these are the few key considerations from the financial sector. Let's move to the GIFT City reforms which have been proposed. The first one is establishment of single window IT system for registration and approval from IFSCA, SEC authorities, GST and RBI, SEBI and IRDA. Now, why is it important? This is important because what is happening right now is that, or just to take a step back, see, the original design of SEC regulator was that it was meant to regulate, monitor manufacturing and IT related entities which were set up in SEC and IFSCA. I think everyone will be aware that IFSCA, or the GIFT City, is also an SEC special economic zone, and that's why the SEC regulations also apply to entities which are setting up their shops in the GIFT City. Now, SEC regulator is mainly responsible for regulating and monitoring manufacturing and IT related entities. And IFSCA, which is the regulatory body in IFSC, is mainly responsible for governing the financial services entities in IFSCA. The problem there is that if an entity or if a foreign investor wants to set up a shop in GIFT City, as of now, they require registrations from both IFSCA as well as the SEC regulator, which increases the compliances, which is very time consuming. Or just to lay down few negatives which are there, are firstly, a lot of SEC regulations are irrelevant for the financial services entities, because, as I said, those SEC regulations are mostly legislated for manufacturing and IT related shops. But those automatically are also applicable to entities which are engaged in financial services. So that is first. Second, the compliance with these regulations and rules are very cumbersome at times, and because they are not very much relevant to entities which are into financial services, that becomes a task at times. Third, this dual regulation by IFSCA and SEZ authority itself defeats the purpose of IFSCA being a unified regulator, where people from SEBI, RBI, and other regulatory bodies are present and they take the final decision. Now, because if you're required to take approval from both the authorities, the power, the authority of IFSCA being a unified regulator gets diluted. The fourth, and which is a very relevant cause of concern, which we have seen, especially in the funds industry, is that if you look at IFSCA, there are foreign exchange management regulations where funds are set up in IFSCA, in the gift city, IFSC, sorry, in the gift city. Now, what happens there is that if you look at the regulations, the fund manager is supposed to take registration and get regulated by IFSCA. However, what happens is that because SEZ authority also regulates fund and fund managers, both these entities, fund as well as the fund manager, are required to take separate approvals from IFSCA and SEZ authority, which means that both these entities, fund as well as the manager, are supposed to release their own office spaces, and they're also supposed to comply with the registration requirements which are laid down by IFSCA and SEZ authority, which increases the compliance for both of these authorities, both of these entities. Now, because a single window IT system has been introduced by this budget, all these issues and concerns will be eliminated, and there'll be one system where the approvals will be filed with IFSCA, and they will sit on the application and they will give all the approvals instead of filing different applications with different authorities in the gift city. The second is the establishment of International Arbitration Center. In fact, this was proposed in the earlier budget as well, in the last year's budget, but there was no amendment which was made in the IFSCA Act. Now, the Honorable FM has proposed that there be required amendments made to the IFSCA Act to facilitate the establishment of International Arbitration Center in gift city. Third is the establishment of subsidiary of Exim Bank, which is the Export-Import Bank of India. Now, you may be aware that Export-Import Bank is a government-owned bank, which usually provides soft loans to exporters and people who are engaged in the export-import business. As Dr. Ghosh pointed out, that India in the coming years, or in this calendar or financial year, a lot of exports will be done from India, and the percentage will increase. Establishment of a subsidiary of Exim Bank, which will facilitate these exports and imports, is a very welcome step. The fourth is what the Vishal was speaking about regarding permission to issue offshore derivative instruments by FPIs and IFSC. Now, the legal issue which was there before this budget was that under Securities Regulation Contract Regulation Act, SCRA, Section 18A defines what are legal or valid contracts in India, and that provision included those contracts which are traded on recognized stock exchanges in India, or which are cleared or settled by the clearing houses of these recognized stock exchanges, or those contracts which are recognized by the Government of India as valid contracts. There was no such provision which was recognizing an offshore derivative instrument being a valid contract, and that's why the FPIs, which were based out of gift city, they were not permitted to issue these offshore derivative instruments. Now, they were lagging behind FPIs which are based in Mauritius, Singapore, or all these offshore jurisdictions, because in Mauritius, Singapore, and all these jurisdictions, the FPIs which were based out of these jurisdictions, they were issuing offshore derivative instruments to investors who wanted to take synthetic exposure to make investments in India, because SCRA does not govern these institutions which are situated in offshore nations. And that's why gift city FPIs were lagging behind these FPIs. Now, what will happen is that FPIs in gift city will be at par with the FPIs which are situated in Mauritius, Singapore, Hong Kong, or any jurisdiction from where these FPIs used to issue ODI instruments. So this is a welcome change. This enables FPIs in the gift city to be at par with the other offshore FPIs. Of course, we should remember that under the FPI regulations, only category 1 FPIs are allowed to issue offshore derivative instruments, and only persons who are eligible to subscribe who are eligible to get a Cat 1 FPI license are permitted to subscribe to these offshore derivative instruments. Of course, FPI regulations and a master circular issued by SEBI with respect to FPIs will be applicable to the FPIs which are situated in IFSC as well. Now, the last key change is that IFSC banking units are now permitted to undertake acquisition financing, which again will help these banks in helping institutions to help in their merger demerger activities, or in acquiring different entities, whether by stock purchase or leverage buyout, or any other mode of doing acquisition financing. So these are the key considerations or key changes which have been made, which are proposed by the finance bill, and we see these changes in a very positive way. Of course, there are few things which could have been done. For example, we were waiting to see some sort of proposal for Indian entities being listed on offshore stock exchanges and all those sort of reforms or proposals, but those are not there. Any case, important and welcome changes which we are seeing in the finance bill. Thank you.
Thanks, Prakhar. I get your point where you're saying that expecting some more reforms, but then as Mr. Ghosh also said, and he also said that that this is a stepping stone probably to a long-term view, and where Europe, you also made a point that the government is going to do consultation with the market intermediaries. So probably that's where you guys need to probably push for these reforms, and that's where they could be probably a part of the budget in the coming years.
I hope so.
Hope for that. Yeah. Okay. Thanks a lot, Prakhar. Our next panelist is Mr. Jean-Francois from SG Securities Services. JF, as we call him, has been with the firm for more than 25 years and is currently the country supervisor for Africa, India, and Switzerland. He started his career as a relationship manager for cash clearings business and moves on to asset management. He's also an alumnus of the KED Business School in France. Over to you, JF.
Thank you, Jinesh. This is very much appreciated. I would like first, to thank warmly Mrs. Souma Sankmuki-Sisla, the CEO and MD of SBI-SG, for giving me this opportunity to share, I would say, a view from overseas on the recent evolution and this year's India budget as well. So this is a great opportunity, and I am all the more happy to do so as we view from SGSS standpoint, SBI-SG as a great source of growth for our security services business. We have seen it over the past decade. We are confident that this growth should be pursued in the coming years, as it has been done over the past. So let me first share a couple of features of SGSS, the partner of State Bank of India, into SBI-SG. Société Générale Security Services has in excess of 4 trillion USD of assets under custody, and is one of the top 10 global custodians. And we are very proud to bring, I would say, this experience and this technicity to the JV that we have in India. We rely on a sub-custodian network to provide access to international investors to in excess of 80 markets worldwide, including 27 countries and markets that we cover directly through a subsidiary or a branch, providing the best level security on the assets that we have under custody. And of course, this is the case in India, thanks to this very promising JV that we have SBI-SG. So we would like to repeat again that we are very happy to be part of this Indian adventure through the JV that we have with SBI. And we are all the more so as we see how the ease of doing business is improving, so we think at least, for domestic, I would say, players, but of course, in particular also for international investors that we are used to serving at SGSS. We view the objective in the 2023 Indian budget of yearly growth of 7% as both a very strong and very positive message for the international audience. It is all the more impressive as we are just coming out of the pandemic period. So this is really a very positive message that India conveys in this part of the 2023 budget. Once again, we have noted with great interest the economic sectors that are particularly in the focus of this budget this year. Inclusive development, last mile connectivity, infrastructure and development, startup and new technologies, green growth, youth power and financial sector. Of course, the later part, the later sectors that I have mentioned is particularly dear to SGSS heart, and we hope, as Praktar has shown, that the initiatives on the gift city in particular will make life easier for FPIs. From the FPI FDI perspective, we hope that these key areas in the Indian economy will fuel additional capital into Indian capital markets. This is really something very encouraging. What I would like to say on top of it is, you know, we have gone through some difficult years, not only in India, but worldwide. And I must say that I was particularly impressed on how well India has managed the pandemic challenges over the past 3 years. And it makes me still more confident in the capacity of this country to face potentially similar challenges in the coming years. So it has definitely boosted the trust, the confidence that we international financial institutions have in the economy of India. So in this general context, what has been, I would say, SBI-SG main achievements, you know, to accompany this growth in India? We have successfully completed the T+1 settlement cycle in order to bring, I would say, a better level of risk management and asset safety for our clients. It was done thanks to significant IT investment in our platform operated by SBI-SG. So once again, this and the gift city developments make us very much looking forward to the future for Indian capital markets. And we are definitely confident and happy to be along with State Bank of India in the security services sector into the Indian market for, I would hope, a long period again. So happy to be part of this adventure, and thank you for giving me the opportunity to share my views. I am happy to hand it over to you, Jinesh.
Thank you, JF, for your thoughts and the global perspective that you bring in from one of the top banks of the world. We will now take a few questions, that have been posted as part of the participants, who have registered for this webinar. So, okay, here, one question that has come is, probably this is for you, Mr. Jain. What impact budget 2023 will make on the environment from the ESG perspective? That was, you covered it in the last piece of your slide. So that's why I'm putting this to you.
No, I think it's probably the greenest budget we have seen.
Yeah.
The clear, green focus. In fact, they said out of the seven priority, the one priority was green growth. And I think India has done a lot of work in trying to build this as the USP for the country. The world is moving towards a green transition, and India is trying to become a leader there. The biggest thing was announced actually pre-budget, and I talked about it, the whole green hydrogen mission. About 19,700 crores worth of allocation has been done, and I think we're going to do something like a 5 million metric ton by 2020 final production. That's a huge number. Another thing that I again touched upon in my talk was 35,000 crores has been for the first time kept aside for energy transition, right? I don't know exactly how they will use. This has been given to the Ministry of Petroleum and Gas, and this will be used for the energy transition and net zero objective by 2070. So I'm assuming this is the series of the first few investments that will go in towards the transition. Giving money makes sure that this money goes into the causes which are measurable, and that's a big thing. And then the whole viability funding gap that they are giving for battery ecosystem, EV being focused, because one of the big issue there was would you have enough battery energy storage capability? That was a big thing. One other thing was this special, special project in Ladakh for the solar. I'm assuming solar because they've not mentioned what it is. I'm assuming it's a solar, huge investment that the government wants to bring in. Govardhan was another one which comes to my mind, which is a very unique thing, the waste to wealth, which they've been talking about. And like in fuel, this is the first time we are saying 5% compression, compressed biogas to be mixed with the regular natural gas. I think it's like similar thing that we are doing with petroleum. That again is also very positive when you look at it. There were a couple of initiatives. I'm not sure what it is, because there is now a special initiative of mangrove afforestation and a wetland conservation. So we've got to wait and see how this is going to play out. But as I said, this is the greenest budget we've seen. Tons and tons of green initiative being announced this budget.
Thank you so much for your thoughts on this. One more question. This probably is for Vishal. What are the implications for FPIs investing in India via the DIFC registered company? And you can also comment on the ease of investing, and regulatory framework over there.
Sure. Thanks, Jignesh. So maybe I'll take the regulatory framework and ease of investing first. I think as a start point, any investor looking to get an FPI license in India has to now approach the custodians in India and fill up a single form, which is a common application form. That application form enables you to do three things. One is register, take your FPI registration from the custodian, which is a delegated authority from SEBI. The second part is to open your cash and securities account. And third and finally, get your India tax ID or the permanent account number as well. So all three of these activities that were earlier spread across three different forms are now consolidated and can be obtained from a single window process. Together with this form, of course, you have to fill in information around, background of the investor, the ultimate beneficial owner and all of those details and provide certain documents. But I think pretty much with streamlining and consolidating this entire process under a single window approach, the timeline for obtaining a registration and setting up an account to start trading in India markets has considerably come down compared to what it used to be earlier. So that's the ease of doing business and the registration process. The tax lens, again, for an FPI, there is a special regime in the Indian law that allows you a rate of 10% on long term, 30% on short term, and 20% on other income, say dividends and interest. But if the taxpayer is coming from a jurisdiction which has a treaty, and India and UAE definitely have a treaty, one can evaluate whether a lower rate of tax on dividends and interest is available under the treaty. Like I mentioned earlier in my presentation, the 5% rate on bonds is now at a sunset stage, but it is still open for investors to evaluate if a treaty is applicable. And there are conditions around documentations, as in you have to prove that you are a tax resident of UAE, get a tax residency certificate, look at beneficial ownership, and this will depend on what is your contractual arrangement with the investors, if any, at the back end. Are you obligated to pass on your income that you earn from India investments, etc.? So there is some analysis and work to be done, which needs to be undertaken to evaluate this. But it is possible to claim a lower rate of tax under the tax treaty. The alternative could also be to set up an FPI in the IFSC. Again, that allows you, at least if I can recall correctly, and comparing to only the UAE treaty, almost similar benefits as the treaty itself. So again, depending on the fact pattern and what are the areas or avenues of investment that one is interested in, this can be evaluated further. But definitely there is a regime or treaty in place to look at some lowering of the tax rate if an investor is investing from the UAE. Sorry, Jignesh, I think long-winding answer, but I just thought I'll cover all the aspects comprehensively as I could.
Absolutely fine, Vishal. It's good to give a little bit of more detail rather than, let people assume something. One for you, Prakhar. Yeah,
sorry,
okay, please add on. Yeah, add on.
Yeah, I was going to add something to what Vishal said. This is important to highlight actually that SEBI has been trying to improve and smoothen the process which is taken by FPIs to get registered in India, and also the investment which they're making into India, right? So for example, very recently, SEBI permitted FPIs to invest in exchange traded commodity derivatives, ETCDs. That was not permitted, right? That was permitted if you had some sort of physical exposure. So that regime has been overhauled, and now FPIs can invest in ETCDs. SEBI has also set up an FPI advisory committee, which has around 15-16 experts, and they are sitting upon and they're discussing what all improvements they can make to further ease the FPI framework and streamline that. So a lot of efforts are being taken by SEBI to streamline the framework. Just last example, recently SEBI came out with a circular where they said that see, currently what happens that, as Vishal said, for an FPI registration to happen, the initiative is that you approach a custodian and you get the application and all those documents filed with the custodian. And the process is that before filing your application forms and documents on the portal, the NSDL portal, or after that, actually, you have to submit the physical documents with the custodian as well. Now, there will not be any requirement to file physical documents with the custodian. And in fact, the scanned copies will help the FPI get the registration. So all these initiatives are being taken by SEBI to make the ambience, the investment environment for the FPI is more streamlined and smoother as compared to what was there in the erstwhile regime. Yeah, that's all I wanted to add.
Thanks, Prakhar. Just one follow-up question on that. apparently we did not hear anything specific in the regulatory changes on the ODI, FDI. You think there are any specific points that you need to cover on this, or probably what is the difference between the ODIs that were there earlier and now?
Yeah, so Jignesh, I remember discussing with you as well last evening that there are we can't see any changes in the FDI FPI regime. But then on second thought, I realized, now to break it into 2-3 parts. One, as far as overseas investment regime is concerned, it has recently been overhauled by Government of India and RBI. So on 22nd of August, new overseas investment rules and regulations and directions were released by government and RBI. And they actually liberalized and relaxed that regime where, in fact, round tripping is permitted, of course, subject to having 2 subsidiaries offshore. And a lot of liberalization has happened for Indian entities investing outside India. So for just to give you an example, before that 22nd August rules, Indian entities which were not engaged in financial services could not make overseas investment in a financial services or a non-financial services entity outside India. Now this has been permitted. So an Indian entity which is engaged in financial services or a non-financial services activity can make investments outside India subject to satisfying certain conditions. So what they have done under the overseas investment rules and regulations is that they have relaxed it, they have liberalized it for entities. Of course, for individuals, the few restrictions have been put in, and that's why I thought maybe the government was not very much focused on saying something on overseas investment, because recently it has been done, and the ambiguities or the gray areas which are prevailing right now. We recently had a meeting with RBI where they said that they are working on certain queries and issues which they have received from different market participants, and they'll be releasing the FAQs soon. So maybe that was the reason for not legislating anything on ODI. As far as FDI is concerned, yes, I thought there'll be few changes or few reforms in the FDI policy. Maybe on press note 3, where they haven't defined what is beneficial ownership. Maybe they could have defined what is the meaning of beneficial under press note 3, and the clarifications around deferred consideration. So all those points could have been there. And as far as FPI is concerned, as I said, advisory committee has been set up. SEBI has been taking steps. If I talk about few modifications or amendments which we are expecting under the FPI regime, maybe they will relax further the investment limits which an NRI or an OCI can hold in FPIs. Right now, those are 25% at an individual level and 50% at an aggregate level. Maybe they can further relax that, because a lot of investments are being made, and a lot of NRIs and OCIs are interested in making those investments. And anyways, the KYC and due diligence requirements have been increased by SEBI over time. Also, there are certain gray areas in releasing in issuing offshore derivative instruments. Of course, now IFSC can host FPIs which can issue derivative instruments, but still, who can subscribe to offshore derivative instruments is still sort of gray areas there. So yeah, there are 5-6 points, and in fact, we as an NDA, we also wrote an article, and we made representations to SEBI saying that these things should be further relaxed. So all in all, or this morning, I thought maybe it's okay. They are focusing more on macro level issues, and as Srinivas said, it's the greenest of the budgets, and maybe their focus is something else rather than legislating on micro issues, which can be tackled by different regulatory bodies after the budget is released.
Thanks, Prakhar. These are all the questions that I had. We received few questions, but around the same theme, so we consolidated them and got them clarified here with the speakers. So thank you all the participants and the panelists for their valuable thoughts on the budget. We hope the budget delivers what it is aimed for. With Dr. Ghosh saying that achieving of the 20 trillion economy by 2047 or earlier. Let's keep our fingers crossed for that. We also thank all the audience for their time, and we sincerely hope the webinar has helped clarifying your doubts or enhance the knowledge in the session. Thank you so much, everyone. Have a nice evening, and have a nice day to the rest of the world.
Thank you.
Thank you.
Have a good day ahead. Bye-bye.
Bye.